Hi, everybody. How we holding up? Yeah. All right.
Bring the energy, huh?
I can feel it. I can feel it.
Adam, I'm still waiting on your dance.
It's coming. It's coming.
That's
Just
at
at
the
the right
end,
moment.
right?
I
You
was
gotta
like
leave
the
the good
right
stuff
moment
for
to
the
break out into dance, and it might be a dance off. So be careful.
Good thing
All
I'm
right.
dancing.
Thank you, everyone, for sticking around for our panel on platforms and liquidity. And we have here, just so you know, we have on my left, we have Juan Hernandez from Open Finance. We have David Benizri from River. And we have Lior Shimron from Nova Block Capital. I don't know if they updated it. We had a little late inning pinch hit for the panel. So thank you all for joining us. To get started, maybe take 45 to 60 seconds maximum on each of you. Who are you and what do you do?
Okay, great. I'll start. So my name is Juan Hernandez. I am the CEO at Open Finance Network. We are the first U.S. regulated security token trading platform. We are registered with the SEC and FINRA as a broker-dealer and an alternative trading system, an ATS. And we trade all of the security tokens that have been issued on the Ethereum mainnet today. So that includes instruments like Blockchain Capital and others.
Hey guys, my name is David Benizri. I'm the co-founder and CEO of River. I came from a 16-hour flight from Tel Aviv. So, hi guys. River is an end-to-end fund management and issuance platform tailored towards digitizing private equity fund interests. We provide the whole 9 yards during the tokenization stage, and then we don't stop there. We also provide a fully servicing fund admin, ranging from investor onboarding to capital calls to reporting, cap table management, secondary market integration, and etc.
Hi, everyone. My name is Lior. I'm the CEO and co-founder of Nova Block Capital. I'm the late-state addition. My partner, Nisa, unfortunately, she came down with an illness, and she's a bit more charming and funnier than I am, but hopefully we can make do. So Nova Block Capital, we are a venture fund that is building out the next generation of capital markets and seeding the foundation for the future global economy.
Love it. Well, let's stick with you, Lior. Tell us a little bit about how we got to where we are. I know you have a great kind of overview insight. I come from the crowdfunding world. This whole space comes in a way from the crowdfunding world. Tell us how we got to where we are, where we have platforms and we need liquidity.
Sure. I think we are in a very unique point in time right now as an industry. It's clear to us that the STO space is really kind of an offshoot and a natural evolution from the securities laws that happened in the 1930s all the way up to the Jobs Act that happened in 2012. This is just the next iteration of that. Nothing really new, nothing really fancy. As an investor, we always look at the macro trends and trying to analyze exactly what's going on in a big picture. It's clear to us that the private companies are staying private longer. You see, since 1996, there's a reduction of 50% in companies that are public, and every year since then as well, you have 2/3 less companies going public. This is for a couple of reasons. This is because there's a declining cost of capital in the private markets, as well as increasing regulatory burdens, with the SEC and FINRA. I think moving forward, we'll see STOs and security tokens and digital securities really forming kind of a new basis as an alternative to going public, and we're already starting to see a lot of growth in that area as things stand. I just saw a report actually this morning that $120 million has been raised globally in Q1 of 2019. Now, this is a far cry from the ICO boom in 2017, in which we saw over $20 billion raised by an international investor base, but it's clear that we're trending in the right direction.
Fantastic. Okay, so let's do a little dictionary for everybody who's following the space. We've got STO, we've got DSO, we've got TSO, we've got all these things. Is a security token, is that the same thing as a tokenized security, and is that the same thing as a digitized security, David?
I'll start off with that one. So first thing I'll say is digitization is the most painful word to say in any kind of presentation. Okay, sometimes I use the word tokenization, which I'm personally not the biggest fan of, just because it's simpler to say. In my opinion, they're all the same thing. They're all one and the same. As long as you have the word securities in there and they're fully compliant with regulations, there's no difference. I think the main differentiator is Is it the security, or is it any of that ICO stuff? That's basically where I put it.
Yeah, to me, they're all securities at the end of the day, whatever adjective you want to put in front of them. They're all securities. They all have to comply with existing regulations and rules. Tokenization is a form of digitization where the data is represented on-chain, but ultimately, I think the terminology that we're starting to lean towards and prefer is digital securities. That seems to cover the widest swath, and it has the most appeal and recognition to both retail and institutional players.
Okay,
Yeah,
so
I think going off of that, it's clear that the industry has a nomenclature problem. You know, are they digital securities? Are they security tokens? Are they smart securities? I've even heard, you know, tokenized assets, blockchain securities. They all mean the same thing at the end of the day. You know, these are just private placements with a digital wrapper. You know, we're using the benefits of blockchain running in the back end, and hopefully in the next 5 to 10 years, when everything has blockchain running on the back end, we won't even be talking about this stuff.
So a lot of people in this space come from tech. They come from blockchain, and they're like, oh, it's the new wave. It's 1995 again. It's the internet, Netscape moment. It's blah, blah, blah. And then there's also the people who come from finance, right? So I think that sometimes there's a little bit of a valley in between where the people in the former group assume everybody understands what they're talking about, and the people in the latter group assume everyone understands what they're talking about. And a lot of times, terminology and actual fact gets lost in the middle. So just to throw out an example, the idea of a public versus a private chain. And is there a use case? And is it always one or always the other, and why not? I guess I hinted at what the answer is. Does anyone want to grab that?
Sure, I'll
Okay.
pitch in. So River is one of the first issuance platforms to build on top of Hyperledger Fabric, which is a permissioned blockchain built mainly by a collaboration of IBM and Linux, which, you know, I'm personally a believer that one day we'll see Ethereum and Bitcoin, but I think for today, private chains is a very good first step towards getting people that aren't necessarily in this room with us to come to the next conference, let's say, for example. I think it provides a sort of transparency and increased security, which is more guaranteed on a private chain. Not that it's not achievable on a public chain, but because you have names like IBM and Linux, and you're able to say in theory that it's a limited, permissioned network that have access to our nodes, we're able to pass on this confidence to our investors and our clients, and et cetera. And I think also, this may seem like a little detail, but people do not, especially investors, do not like having to create digital wallets. And when you deal with Hyperledger, the ownership information itself is distributed. There's no need for a centralized token where that person has its information on it. The actual ownership is distributed the same way any kind of information is distributed. So that spares the need to create a digital wallet, which removes a ton of friction for investors.
Yeah, at Open Finance, we're chain agnostic. Right now we work primarily with Ethereum because that's where a majority of the security tokens have been issued, but Stellar, Hyperledger, other formats are starting to pick up a bit of traction. But at the same time, the debate of public versus private, or what chain should I use, or which chain is better, I think misses the point that at the end of the day, the issuers that we need to get into to start getting involved in this industry don't really care about the technology aspect per se. They just need a solution that works, and they need a set of tools that actually can deliver upon some of the feature sets that David here was touching on. But I think we get a little too caught up in, Hyperledger this, and Stellar is better than Ethereum, and is EOS going to come and dominate one day? I think that's missing the point, and it's part of the reason why we kind of are in this space where there's not as much institutional level adoption as we'd all like to see.
So you're saying because the issuers you mentioned have a wish list of benefits, it really doesn't matter how we get there, right? And then what about investors? Do they have a wish list of benefits? Like you were talking about the wallet-free environment. Yay, I don't have to worry about my key, or my dog ate, my kid stole it, or
Right.
put like Roblox on it,
So,
whatever.
yeah, at the end of the day, especially for larger institutional investors, they're not going to be managing alphanumeric private keys.
Right.
They're not going to be uploading their tokens with MetaMask. And, right now, UI UX is clunky. And I think we all kind of recognize that as an industry. That's a solvable problem. That's going to come with time. I think also as the public chains mature and as they scale, As the public chains, as they scale, naturally UI UX is going to follow as well. I've seen projects that intentionally implement poor UI UX because they understand that if they have a rush of users, Ethereum is going to break, and they don't want that.
Wow.
Wow.
That says a lot, right?
I've never heard that one before. That's
Yeah.
I mean, I can believe it, absolutely, but I've never. Wow. Yeah, I'm speechless.
I mean, that in a nutshell is sort of, that encapsulates why we're a little bit in a slow growth trajectory, I guess. If people are intentionally building friction onto their platform to prevent growth, that's not a good.
I'm not going to mention the project.
We won't say who. We won't say who. Okay. So, what about? You're talking about friction. What about? Sorry, SEC, but when you mention friction, I think about regulations. Is there enough? Is there too much? What's the story with regulations, Juan?
Yeah. So at the end of the day, regulations first and foremost around investor protection. So certainly to folks in this room, perhaps, who might be a little bit more tech savvy, who know what we're talking about when we say what's the difference between Ethereum, Stellar, Hyperledger, et cetera. We might think regulations a bit heavy-handed right now. But to a Main Street investor, to a retail investor that is looking at these types of investment opportunities, they see a lot of confusing terminology, a lot of confusing structures, a lot of different options out there, and ultimately regulation is there to protect them from all of these different, perhaps less than legit offerings on the market today. And so I do think from the retail investor's perspective, there likely needs to be a little bit more regulation, but light-handed and more clarifying type regulation.
Clarifying, yeah.
Yeah. But I think to me, Leo touched on the fact that the Jobs Act was a refresh of the 1930s laws, and I do believe that we're in a rare scenario where the technology itself just is not caught up to some of the regulatory changes that have occurred over the last couple of years. And so I might be in a minority here on this panel in the sense of that perspective, but that's how we see the regulatory landscape play out.
How do you guys feel about the friction of regulation?
Yeah, so, this is a very nuanced discussion, nuanced conversation. Look, we need protections. We need protections in place. There's no quicker way to kill an industry than to have, just an outpouring of scams, people losing money.
Yeah.
Regulation is not going to protect against bad investments, but it should protect against outright scams. So it's incumbent upon the investor to do all the necessary due diligence and make sure that they have an understanding of what they're investing in, what they're putting their money in. Regulation is necessary, but we need to take a measured approach, and I feel like the SEC has been taking a measured approach. I know they get a lot of, a lot of people diss them, but it's just part of the game.
Yeah. I like a lot of the things the SEC have been doing. I've been totally surprised by how nimble and actually with a sense of humor they have.
Yeah.
I love the website they put up against ICOs. I thought that was great. So, okay, we're talking about platforms. So, David, is it going to be a commoditized thing, the ability to tokenize an asset? Is that just going to go the way of the web browser?
So, Eric Ries, the writer of The Lean Startup, once defined the startup as the balance between the founder's vision and what the client is willing to accept and pay for. And I think that everyone in this room can definitely agree that tokenization is the only way to go. If someone doesn't see it, it doesn't make any sense, and that everyone should be doing tokenization. But unfortunately, it's not so obvious outside of these walls, and which is why we have to find a way to not give up on our vision, to still keep our vision, because oftentimes, clients don't always know exactly what they want from the get-go. They have to see how the market plays out, and then they're better able to evaluate the situation and then make a better decision. So we have to find a balance. So I think that, to answer your question, down the line, it will be commoditized. But more importantly, we have to find a way today, in 2019, 2020, 2021 even, to be able to add value without having to rely on tokenization. For example, not to sound a little biased, but at River, sorry guys, but we provide fund management, and we tell our clients that you don't have to have tokenization to add value. And I think that everyone should take the similar approach, meaning that if you're doing, private placement, then you should do it with and without blockchain. If you're doing a secondary exchange, you should be able to cater to investors that are dealing with tokens and without tokens. And then to eventually go step by step to be able to see a fully tokenized capital market.
Yeah, I think we are going to see a convergence mostly into a specific set of features. There will be standards that emerge. As an industry, we need to understand that this is obviously a long-term game, and there's going to be a massive pie here that we can all have a share of. If you look at all the assets that stand to be tokenized, globally it exceeds over $250 trillion. So if you look at the number of broker-dealers that exist in the US, there's over 3,000. So there's more than enough space for multiple players to coexist, and I think as my panelist right next to me just said, it's really incumbent upon people to provide more value, especially as an issuance platform. You have to differentiate yourself, and I think we're just starting to scratch the surface there.
Yeah, we don't see too many platforms that just do tokenization. That's all they do. I mean, a lot of them offer compliance as a service on top of it, or broker-dealer services, or additional structures that add more value to the end issuer, because it is a bit of a competitive market to a certain extent. I think at last check, so as a secondary market, we speak with all the issuance platforms out there, and at last check, there's over 80 of them today. They're not all active anymore, but if all you're offering is just tokenization or digitization of an instrument, then you're not really able to compete in the broader market.
Yeah, so one of the sort of holy grails of the whole idea of tokenization is this idea of course, liquidity. That's why people do it in large part. So you guys are a secondary opportunity, which is sort of the home of liquidity. Yep. Where is liquidity right now the most needed? That if we unlock it, everything changes and the tidal wave happens. And why isn't it there yet?
Yeah, if you look at some of the early instruments that are out there, we just had, I think at the 9 o'clock panel, we had 4 investment funds up here that had done tokenized offerings. And so you think about a typical venture capital fund or private equity fund that has a GPLP structure. These aren't necessarily meant to be high-frequency traded instruments, right? You think about, the Regulation D limitations where you can only have 99 U.S.-based beneficial owners. So there's a cap of how many folks can actually own this type of instrument. So again, there's all these factors that don't make these instruments conducive to high-frequency trading in any way, shape, or form. But what is out there today is that ability that has been historically unavailable to LPs that invest in these types of offerings to seek liquidity after a year, after 2 years, whenever they need to rebalance their portfolio over the course of the lifetime of the fund. And historically, you've been stuck in these instruments for 7 to 10 years, or whenever there's some sort of liquidity event in the instrument, in the fund itself. And so for us, just that aspect of being able to actually liquidate your instrument on a secondary market at or near NAV is unprecedented. It hasn't been historically available ever. And then you start layering on top of that the ability for international investors to easily gain access to these types of Silicon Valley funds that they've never had the opportunity to get into before. So that's where we're at today. Some of the limitations, we talked about the fund structure limitations, but there's other aspects of just standard things like information asymmetry in the sense of a lot of these are private companies, and they don't have publicly available data that you can reference as a potential buyer in this instrument. And so these are things that the industry is still working on, the aspect of standardization of disclosures, standardization of reporting. Certainly the SEC has some guidelines on this, but not all of these companies will choose to report at that level. And so that's something that as an industry we're working on that will ultimately then help to facilitate greater liquidity in the markets.
Go ahead.
Oh, thank you, Leo. So I think it highly depends on the asset class, and I think it's highly flawed to say that just because there's a more efficient back office, which is essentially what blockchain provides in secondary deals, that there's going to be more liquidity. That's just one of the features. The way I like to look at it is liquidity is by definition the ease at which you can transact an asset. And part of it is, yes, an efficient back office, but the main part of it is supply and demand. So if this is a market which is non-yet existing, meaning that there's not any kind of secondary deals for this asset class, it is unlikely that we will find, high volume of liquidity in the next 5-10 years. So I think for secondary markets to really be able to provide value to investors, it's important that they focus on markets that are already existing. And they're just adding on an additional value that removes friction, which is digitization on blockchain, which is essentially, as I mentioned, a more efficient back office. So it's very important to first compare both the buyer and the seller side, see what the advantages are, to then afterwards apply tokenization.
Yeah, I think it's pretty clear, at least to me, that liquidity is a spectrum. It's not binary. And it probably won't be, at least in the near term, applicable to every single asset class. Equities are highly liquid as they are. Why do we need to ingest an extra layer of friction in the terms of tokenization on top of that? I think, at least for us, we're starting to see two emerging use cases that are kind of serving as the low-hanging fruit for the industry right now. Those are tokenized funds and real estate. So those are obviously on the opposite end of the spectrum in terms of being less liquid. And when you are trying to transact and get out of those positions, you often have to take a larger hit, maybe sometimes as much as 40 to 50% on your position, just because it's a distressed asset and there aren't buyers. So I think over the long run, I personally believe we're going to see every asset class being digitized, but it's going to take time to get there.
So what about, you started to talk about the classes that are ripe or already maybe tokenizing. Can we talk a little bit more about what are the things that we're already seeing getting into tokens, and then what's the next one? So you said real estate, you said funds. Is there a third one that's either starting or we're about to see?
Well, real estate, just touching on that quickly, I think it's a perfect asset class for fractional ownership, right? Because a majority of the time you're buying the economic interest in the underlying asset, and so that's easy enough to kind of structure and carve out and put on chain and set up the dividend flows to various wallets and whatnot. And even touching back a little bit more on our crowdfunding, the points we were making earlier, that's the asset that really took off in the crowdfunding sector. Real estate crowdfunding was one of the largest areas where a majority of issuers and institutional players started adopting the technology of that day to really start increasing their distribution and creating brand new markets. And so for us, real estate, we've only started to see, I think, the tip of the iceberg there in the current markets. There have only been a handful of projects like the Aspen coin, which was a project out of, they did a...
St. Regis?
Yeah, and then there was... I know Harbor's working on a couple of offerings, and there's a handful of others out there, but yeah. I think we're just at the tip of the iceberg there. There's a lot more simmering on
Right, and again, those are just private securities. Those are just private placements, right? We're talking to a few companies that are tackling the non-traded REIT space.
Yep.
So these are traditionally highly illiquid markets, but they're big markets. In the U.S., there's $5 billion of new issuance every year, sitting on an inventory of over $100 billion. And generally, you just have a dozen or so large private equity funds that are trading amongst themselves because they need to put in $100 million just to meet the minimum. So I think, as Juan was saying before, fractionalization of ownership is obviously one of the tangible benefits that we're starting to see. Really automating all of that back office processes, and as a result, you can just make the process a lot more efficient and reduce the frictions to trade.
Yeah, I'm just going to add one last point. First of all, well said, Juan. I definitely agree that real estate is promising and can be promising. But I'll add one point, is that it's very important that us as the issuance platforms, who we bring on as the first use cases of tokenization of a security. Because if we, most people on Wall Street are rooting for us to fail, and that's just the reality of it. So if we bring in low quality, medium quality assets, and we're saying, this is the first use case, and they don't raise a lot of capital, and they don't have a lot of secondary trading volume, and then they're going to blame the whole technology behind it as the reason why these assets didn't succeed, which is highly flawed. So I think for real estate especially, it's important that we have A-grade, top quality assets that are being tokenized, and that we make sure that we really bring in those kinds of projects, especially in the next coming year or
Right.
so. And I think this also applies a lot to funds. As I was telling, actually, I had a nice conversation with Leo right before our panel. I was telling him that if a fund is only able to raise capital because it is being digitized, then I think there's a problem there, because the way it should be is that the fund managers are able to raise capital with or without being digitized. It's just an additional layer, an added value to their investors by being digitized on blockchain. They can add on more fluidity, but it should not be reliant on that. Same thing with real estate. If it's only able to be funded and traded because it's on blockchain, it's not a good quality asset. And that's just my two cents.
It's that adverse selection bias that really plague things like crowdfunding. That if the quality of the deal is so low that they have to turn to these markets, and certainly just creates a very vicious cycle where you just have this continued low quality product coming forward. But for us, I think you mentioned you come from the crowdfunding space as well, and so we've been active since 2014. We started in the crowdfunding market also. The thing we see that's promising in this market that it's not repeating the same mistakes as we did before is that now you have this higher level of institutional participation that just never existed in crowdfunding. So you have folks like Fidelity and Goldman and others who are actually doing projects and or dipping their toe into this market. You've got transfer agents like ComputerShare that are also running pilots in the industry, and that just never really existed in the crowdfunding space.
So what is the profile of the institutional investor in this space? Is it someone, I think, Dave, you said they're rooting for him to fail, or somebody said that a second ago. And are they rooting for the industry to fail, or are they rooting for the industry to be subsumed into their own belly? And I don't know. And so the other part of the question is, are we kind of moving toward an analog to the peer-to-peer lending space where, it was like this democratized hope with I'm going to lend to you and you're going to lend to me and it'll be great. But in fact, today it's 98%, hedge funds.
Sure. Institutions are genuinely interested. They're still in the information acquisition mode. So, we have plenty of meetings with larger institutions that are still just trying to learn, what is the space all about? I know obviously this is a cliche, but education is key, and just the institutions aren't there yet. They don't quite understand what liquidity means. They don't quite understand, what programmability of securities and programmability of assets means. And it's incumbent upon leaders in the space to really teach them that. But I think it's really encouraging to see that they're actively asking the right questions and that they're curious. So it means that, even if they're not coming right around the corner, maybe it'll take a bit longer than we expected. I think we'll see a large wave of institutional funding come in the medium term.
The sense that we get is a lot of these firms prefer to lead from the back. So they're waiting for others to kind of step forward and be those guinea pigs, if you will. But I would say a majority of the institutional firms we've talked to, both at the issuer level, custodian, brokerage houses, transfer agents, are all exploring it and starting to start to figure out, does this make sense for us? How do we start to dip our toes in there? But I would say about a year or two ago, if you took these kinds of meetings at these firms, they would just laugh you out of the room and just say, oh, yeah, come back in a year or so. And I think now we're at that place where that conversation's happening in most major boardrooms.
What guidepost needs to be passed for them to jump in? Is their pain point?
There's a few prerequisites that need to be in place. I mean, the first one is custody.
Yep.
We don't really have institutional-grade custody right now. I mean, Fidelity-backed, they're in a soft beta right now. When they go live and they scale, perhaps we'll be there. But as things stand, the custodians in the space don't quite cut it, and they just don't trust them. You need larger.
Yeah, I'll jump in. I think that they're just, you've got players like Prime Trust, like BitGo, like Kingdom Trust, and others that are starting to lead the way and pioneer the sector. But it's not that they don't cut it. I think it's quite frankly their balance sheet is still too small, right? I think the larger players need that sense of confidence to know that if Fidelity's cussing your assets, if something
reputation matters too, though.
To a certain extent, but I do think it's balance sheet. All the folks I've talked to is like, what's the balance sheet look like? What does the insurance product on top of it look like? It's all about risk management at that level.
Yeah,
Because there's still this assumption that if you lose your keys, what's going to happen? Who's responsible in that scenario that if you lose your keys, what happens to your customers? If they just lose all their assets? And that's obviously not a very acceptable outcome. And so I think there's some education at that level, but ultimately it comes down to risk management.
Yeah, from my experience dealing with institutions, they have the questions absolutely about custody, about regulation, but those can be answered to a almost acceptable level. But then again, the point where I found the most friction dealing with them is that they always ask about the secondary liquidity. I tell them that there are great projects that are being developed, like Open Finance, Archeck sitting here, and several others, but they ask about the volume. And as we know, it's growing, but we're not at the point where we could say that the volume is there. So that, I think, is the biggest limitation, and definitely custody is also a huge one.
Yeah.
So what is the volume that triggers hedge fund mania, do we think? I won't hold you to the number, don't worry.
You need a hard number?
Soft number.
I would say, I won't give a number. I'll instead sidestep the question.
Yeah.
Say
If it were a fruit, if the number were a fruit.
I'd say I'll sidestep it and say distribution. I think is that's not a number, but so right now we're an ATS. So which just to oversimplify it, we're an exchange-like entity that can have other broker-dealers subscribe to our service, and then they can receive automated price feeds and then send in electronic orders into our system. There are no broker-dealers out there today that are subscribing to us yet because there aren't very many broker-dealers that are doing this type of activity yet. And so to me, the question is not what's the magic number? Is it a billion? Is it 100 million? It's likely once we start seeing more broker-dealers active in this market that can plug into either our ATS or one of the other ATSs that are out there, at that point, you'll start to see a lot more activity and turnover that'll interest a larger audience. Because right now, we're having to go out and find all of our retail users, but if we could plug in with another broker-dealer that already has an installed base of users, then that'll open up the floodgates to a certain extent. So.
That's interesting. I like that answer. It's better than my number question.
Yeah.
Yeah, I don't think, I agree with Juan. I don't think broker-dealers can be understated. Broker-dealers are really crucial in terms of building out that buy-side demand, especially in the capital formation phase. As I mentioned before, there's thousands of them out there. The largest ones aren't really even looking at the space quite yet, but I think that they will be compelled to once we reach a particular threshold or tipping point. Yeah.
Got it. Okay, so what about asset classes that, people always talk about in terms of there's someday the liquidity is going to be there, and how much of what we've heard is pie in the sky and how much is really going to happen? When am I going to be able to sell, a third of my Picasso to you, and then you're going to buy part of my car, and I'm going to, get your Pokemon cards, and you're going to buy, when are we all going to be sort of involved in asset allocation and ownership?
So in my opinion, I think that's not a good place to start. I think Picasso and
maybe it's not a good place to start.
And baseball cards.
Pokemon cards, that's not good.
I would sell my Picasso.
I'm sure maybe one day that can work, but I think before we have to take on two risks, right? One risk of creating a new secondary market, which historically has never existed, and the second risk of a new technology for trade settlement, which has also never existed. So I think if you add on both those risks today, it's not worth it. I think you're dead in the water, in my opinion. But I think it's best to start off with existing markets, so therefore you don't have to worry about the risk of supply and demand. Real estate is one. Debt is a very exciting one. Private equity funds is also one. And then from there, I think give it a few more years after that, and I think there can be very exciting projects in the more alternative space of art or diamonds or collectibles and etc.
Yeah, I think David's spot on. These things, they can happen gradually, and then they build steam, and then they happen suddenly. As also David mentioned before, it really needs to be issuer-led. the merits of the deal really have to carry the deal forward. No one's going to get out of bed for something below 10% return. This is a very different, it's a fundamentally different risk profile from crypto assets. We need, maybe it's a real estate property, maybe it's a venture fund, we need assets that are performing to the tune of 20% plus annually, and that's what's going to awaken institutional investors and get them involved.
So whose responsibility is it? I mean, we all talk about when's it going to happen? When are we going to have liquidity? Who's the guy, the woman, the people, the team that has to drum up interest sufficient to create a liquid scenario in our world?
It's a beautiful situation of a chicken and the egg.
Yeah, it's chicken and the egg scenario.
Absolutely. I think the chicken is the quality of the issuers, which I think some are trying to dip their toes in the water, but I don't think we're there yet. I think we're making progress, but we need really one really top quality building. We need one $500 million fund, and et cetera. And then the egg is the amount of buyers we have on secondary markets, meaning that if I'm a quality issuer, do I really provide value to my investors if there's not any volume happening on secondary markets? If I'm a secondary buyer, is it really worth it for me to sign up for secondary trading venues if there aren't any quality issuers? And that's the chicken and the egg. And I think once you resolve that, that's the tipping point, and that's when we'll be able to see more fluidity in the market.
I think it's incumbent upon all of us, all of the different pieces in the industry, whether you're an exchange, you're an issuer, you're a compliance protocol. Everyone has their part to play in terms of educating the industry and making sure all the pieces fit together. I think one kind of shortcoming of the industry is, we're increasingly being siloed. Certain protocols are interoperable with other protocols. That is not going to unleash the true benefits of tokenization as we see it. We want to form a global pool of liquidity, not these different silos that can only allow people to communicate within each silo.
Yeah, I agree with the chicken and the egg analogy, but we think the chicken came first. So a lot of our efforts are focused on institutional audiences, doing education, awareness, showing them what a pilot might look like in this space. How would a digitized security work in the broker-dealer network, for example? How do you take custody of it? How does it work with a transfer agent? How does it work with the various other intermediaries that still exist in the market today? And it's a slow process. I think it's a 1 to 2 year cycle, I think, before we start seeing that. But in the interim, I think you can still have a lot of these more native issuers, native digital issuers that start to continue pushing the needle. We started with a $10 million fund was the first tokenized fund out there. Then you have a $50 million fund and a $100 million fund, and slowly you just kind of get it to the level where a institutional $1 billion fund would feel comfortable, maybe not doing their whole fund using this mechanism, but perhaps carving out a little sidecar, a slug, 100 million or something to that extent to see what it can do on this market, minimize the risk where, if it doesn't get there, you just wrap it back into the main offering. But, for us, it's going to take some time to get to that level.
Yeah, I know from the crowdfunding days, the sort of holy grail was if you list it, they will come. That's like the scenario you want to create, that somebody who decides they want to be a part of this as an issuer has the faith that there's this liquidity that if I just put it up, somebody's going to love my deal if it's quality, and they're going to take it. Do you think it's the broker dealers that are going to be, like you were saying, that in sufficient mass that's going to create that? Is it some kind of a marketing campaign from who knows who that has a sexy deal that everybody now associates with tokenized assets, or is it just some sort of magic?
Yeah,
who knows what?
So we're talking a lot about institutional funds, but a lot of these programs have structured redemption programs included as part of their process, and so the guarantee of liquidity is not as crucial, I think, as some people might make out. So they have already these redemption programs or these self-tender processes that they can do, which is part of their standard business procedures. What a secondary market can do, however, is to create it's sort of a supplemental liquidity valve that allows them to service their customer base in a way that's not detrimental to their AUM. So that's the value to them. It's not this. There needs to be this magical, fully liquid secondary market for them to get comfortable. It's a supplemental aspect that they can then start to build beyond. We talk a lot about distribution channels, right? Like, does this distributed ledger format allow you to tap into capital markets that you never had access to before, right? So most of these large institutional firms work through the broker-dealer network, which is primarily U.S.-based. Well, if you have a way to tap into institutional investors, qualified institutional investors, will that help you bring down your cost of capital over the long term? So those sort of more subtle aspects, I think, are what are at play with the institutional management teams. I don't think it's the promise of guaranteed liquidity. That's not really their main driver.
Mm-hmm.
Yeah, I agree with Juan, definitely on that. And I think I'll add something else, that it shouldn't be a black and white thing. It seems like it should be, but it shouldn't. It shouldn't be tokenized or not tokenized. There's actually a way you can balance to be in the middle, meaning that there's ways that you can actually switch from being a tokenized security back to a traditional security and vice versa. If you have the proper fund structure, if it's written in the PPM, let's say for funds, for example, that you add in certain terminology which enables for frictionless transfer from tokenization back to regular, then again, you enable that stutter step, which enables them to say, okay, I see the vision, but once again, I don't have to rely on this vision to have my fund, succeed in another way or without tokenization per se. So, and I think liquidity, as Lior mentioned, is absolutely a spectrum. Yep. They're not expecting, or if they are expecting, then that's the wrong client to have, NASDAQ level trading from day one. So I think if we can just bring in just an additional layer, bring it from step 1 to step 2, then that already is great value.
Yeah, I think we're going to see an arms race of tokenization. When large institutions start to tokenize certain parts of their balance sheet, that is going to cause a wave, and it's just going to compound, and build, and eventually everything's going to be tokenized. That may sound a bit rosy, but I really think that's true.
That's a perfect way to end. That's excellent. So Juan, David, Lior, thank you for sharing your thoughts with us today. Tokenize the world, baby.
Thank you.
Where's the dance we were promised?
What's that?
Where's the dance?
Dance. Yeah. I'll be dancing later. Come see me.
Come to happy
happy hour.
Happy hour dance off.